So, hi everyone. My name is Janine Robertson. I'd really like to thank you for being here today. We really want to help answer your questions. We're here to answer some live, and we also have some that are pre-submitted from the audience. So, thank you to those people for submitting questions. Before we get into the details, I do want to acknowledge the many lands from which we come together and pay my respect to elders past and present, as well as acknowledging any Aboriginal or Torres Strait Islander people that are joining the session. I am coming to you today from Bidjigal country, which is where I live and am working today. And I'm joined by my colleague, Pat Howard, who is also on Bidjigal land. Hey, Pat.
Hi, everyone.
Also with us today is T Mumba from our coach team. T is on Wurundjeri land and is really going to help us out with the Q&A. So hi T as well. I'm not sure if you can see her on screen. Okay, so you were probably all expecting a disclaimer. Always comes up at the beginning of a presentation. It is really important that I let you know that everything we're talking about today is general in nature. It shouldn't be considered personal advice. We can't answer personal questions in a group like this. So we do really want to answer your questions, but if it starts with should I, then that's probably something we can't answer in this type of forum. Please do use the Q&A function. I just mentioned T's here to help with that. But if we need to connect with you personally, we'll let you know how to get in touch. And if T can't answer the question as we're going through the session, we will come back to some of your questions at the end as well. So first up, I said we've got some slides with some of the common questions that we receive and some of the ones that have been submitted. The topics are really varied. So we've got things about the member portal, we've got investments, we've got retirement. And then after that, we've got some time for live Q&A. I think it'll probably take us about 20 minutes to get through all the pre-prepared and pre-submitted ones that you've sent in, and then we'll do that live session. As always, I really want to make sure that you have some actions, that you've got some next steps to take. So before we jump into the content, I want to remind you the coach team is always available to answer your questions. You don't need to wait for sessions like this, but having a pen and paper on hand might also be helpful if you want to write down any of the Q&As and any of the actions that you want to take. So let's get into it. Pat, we had a few questions come in about using the member portal. So I might throw to you to take some of those ones.
Yeah, absolutely. And yeah, we always get questions about the portal. And it's a really valuable tool for all our members to manage their smartMonday account. So it's easy and fast online. You'll see today on the slides on the left-hand side, we're going to have the question in blue, and then we're going to have some content that addresses that question on the right while we talk about it. So you can see there, the first question is, can I change my current and future investment options using my online account? Really common question, and it's a really simple answer. And your answer is yes, absolutely, you can do that. So to do that, to update your investment choices in the member portal, simply log in, go to the main menu and select Manage Investments. And from there, you can choose to where your current balance is invested and where your future contributions will go to. They don't need to match, so you can change both at once, or you can have them separate depending on your strategy. So just keep in mind that you can make those choices. You've got full control. Once you've submitted the change, and this is really key to keep in mind, it will take 2 to 3 business days to reflect on your account. So don't log in the next day and be stressed or worried that you can't see that the change that you wanted to make wasn't there. It won't happen immediately. So do give it a little bit of time. And at the moment, we are receiving a lot of queries about changing investments, which is understandable in the current market. So don't think that we're glazing past that now because we are talking about changes. We will talk about that a little bit later on.
100%.
Now, next question that we get quite often, especially in the coach team, is about people looking at their transactions when they have logged into their account, specifically tax transactions. So when you log into your member portal, you can see all of the transactions in your account. So definitely worth doing if you're curious about how your super works. And you're going to see that there's funds going in, which we want, but there are also funds that go out. And one of those transactions of funds going out will be displayed as an income tax expense. So keep in mind that your superannuation account, when your employer pays the contributions in for you and any salary sacrifice contributions you make as well, they are taxed at 15% when they enter your account. So you will see that. And the investment income that your account generates is also taxed at 15%. If you have a pension account, you might say, what's Pat talking about? I don't see those transactions. And that's because a pension account is tax-free. So if you're not at the pension stage yet, that's something you've got to look forward to when you retire, is not seeing that tax going out of your account. If you do want to understand your annual tax, you can see that on your statement. The statement will show all the tax that you've paid throughout that financial year, and you can also access that in the online portal. Big question that we get: can I see my investment returns when I log in? So there's two answers to that, and I'll tell you a bit about both ways you can look at your investment returns when you're online. If you log into the member portal, what you're going to find is your personalized return for your account for the financial year. And that'll be expressed as a total dollar value on your statement. So if you look at your statement, it will show you what the investment return was for that full financial year. It's not a percentage, it'll just be a dollar amount. You can find your statement in the Documents tab. As the year goes on, we do quite often want to check how our investments are going. And for that reason, the fund also publishes our rolling investment returns for every one of our investment options. And you can see that on the website. You don't need to be logged in to do that. You can just go to the Investments tab. Now, that makes it easy to understand how things are going through the year. And if you're unsure which investment option you're actually in, log into your account, look at your investments in your account, and that will tell you which investment option that you're in. And then you can go and look how that's performing when you look at the live returns on the website. Now, if you're a bit unsure as to how you should interpret, should I look at percentage or dollar amount, or how does this really relate to me? Reach out to the coach team and we can talk you through about how to think about that and how to interpret that. The last question we're going to address is about beneficiaries. So beneficiaries, I'll tell you a bit about what they are if you're unsure. It's a really, really important topic that every one of us on here on the Smart Monday side would stress to every member. It's really important and it's easy to overlook, but it's also really easy to manage. So your beneficiaries, that's who receives your account balance and any insurance payment if you were to pass away. And if you've not nominated a beneficiary, this death benefit might not go where you'd hoped or assumed that it would. So we really encourage everyone to make sure that you've got beneficiaries in place and also log in and you can check regularly to make sure that they're up to date. There's two types of beneficiaries. There's what's called a non-binding beneficiary, and that provides a strong guidance to the trustee when they determine who would receive your death benefit. The other type of beneficiary is a binding beneficiary, and that's a legally binding instruction from you to the trustee as to who will receive the death benefit. So as you can tell by the way I'm expressing that, that gives you the most certainty as to what would happen if you were to pass away. You can log into your member online portal and you can check who you've got as beneficiaries by looking under the Personal Details tab. And you can add, remove, or edit or update non-binding beneficiaries using the online portal. If you want to make or update a binding death benefit nomination, you need to complete and submit a form to the fund. And you can see the QR code there on the screen. You can do that to download if we hopefully have triggered you to action, or you can download that from our website. So Janine, our next lot of questions about contributions. What are we getting asked there?
Thank you so much, Pat. Okay, so as Pat said, contributions, we will keep moving forward. I think this one gets asked in lots of different formats. When should I consider making extra contributions? Or I'm X age, should I start making contributions now? So there's lots of different ways this question comes to us, but it is really, really common because super is such a long-term investment. So the answer is really, it is up to you. But starting earlier can give you a bit more time to grow your account. On the other hand, locking money away in super is something that you need to consider as well, because if you are making extra contributions, you're not going to have access to that money until you meet what's called a condition of release. So it is a personal decision, but what you can see on the screen here is a bit of a table about the difference that time can make. So starting earlier does give contributions more time to grow, even if the amounts are small. But if you start a bit later, usually you need to contribute a little bit more each year to reach the same outcome. Now, that doesn't mean that it's too late if you're a bit older. It's just that you have to find that balance between time and making contributions. And and really figuring out how that works for you. I think it's true that people often put super at the bottom of their list until retirement feels a bit closer. You might only start looking at it when you kind of get into your 40s or even your 50s, and that's okay. But if you are a bit younger, it's really worth noticing that time's on your side and it can make a bit of a difference. So I guess the answer to this question, when should you consider making a start or looking at your contributions? It's now, no matter your age. Okay, the next one is also about contributions. So I think there's sometimes a bit of confusion here about types of contributions and ways to add money to your super. So let's have a look at how personal contributions and salary sacrifice contributions are different. So both types, basically the end game is the money ends up in your account, but the main difference to think about is when tax comes out. So with personal contributions, which you can see on the left-hand side there, money comes from your bank account and goes into your super. So that might be money that's already been earned by you. You've paid tax on it, and then you use something like BPay to transfer that money into your super account. So that's sometimes also called a non-concessional contribution because there's not a tax concession on it. On the right, you can see salary sacrifice. So that's money that goes straight into your super from your before tax income, and the tax comes out when it reaches the super fund. So Pat mentioned this before. You might see those income tax transactions if you log into your account. So salary sacrifice on the right, that's set up with your employer. They transfer the amount that you decide when they run payroll. So ultimately, same destination, different tax treatment on the way in. But there are a couple of other things to think about here. The 15% tax rate on salary sacrifice contributions, it's pretty likely that that's going to be lower than the tax rate you pay on your income. So that's sometimes a reason that people look at that as an option for making additional contributions. There's also some limits that apply that you really need to be considerate of when you're thinking about this. So salary sacrifice contributions plus your employer payments, both of those together, they need to stay under the limit. And at the moment, that limit is $30,000 per financial year. Your after-tax or personal contributions, they have a limit of $120,000 per financial year. So those caps do change from time to time, and there are possibly some changes coming up on 1 July. We're just waiting on some confirmations of those from the ATO. So if you're sitting in that bucket where you're close to your contribution, worth having a think about and keeping an eye on those caps. Also worth thinking about things like carry forward and catch up rules. So if you want any more information on those topics, if it's made you start thinking about some of those, do reach out to the coach team. We can give you a bit more personal support. There's another thing that sometimes comes up with this topic, which is, what if you made a personal contribution, so a non-concessional contribution, but you actually would prefer it to be in the other bucket, in the salary sacrifice or the concessional contribution? So you might not be able to really move it to a salary sacrifice, but you can make it have the same tax treatment. Is that possible? So that's where something called a notice of intent comes in. And basically that's a way that you can tell your super fund that you want to claim a tax deduction for those personal contributions that you've made. Now, the timing is important here. You need to submit the form before you lodge your tax return, and then you need to wait for confirmation from the fund. So once that notice of intent is accepted, the contribution is then treated as a concessional contribution and taxed at 15%, and then you can claim that deduction when you complete your tax return. So this one can be a little bit more complicated. Once again, if this is something that impacts you, I really would encourage you to have a look on the website. That's where you can find the form, and also do reach out to the coach team to get a bit of a hand if you need it. Okay, investments. Clearly, lots of things going on in the world of investments at the moment, and we do want to make sure that we've got time for live questions. So let me throw a couple of the investments ones at you, and we will keep moving. So why does super sometimes go down? So I want you to just have a look at these data and the graphs that are on the screen. You don't need to worry about them in any kind of detail, but I want you to pay attention to the little orange arrows that are there. So let's start with what's on the left. Now this graph is the ASX 200. This isn't your Smart Monday super account. It's a representation of the share market and how it moves. So you can see that dip at the end of 2025 where the arrow is. On the graph on the left, I think if you look at that, it looks really quite significant. But then when you look at the graph on the right, which is the same dip, but it's in the context of a 20-year trend. So it doesn't look as big at all. And I think especially if you look at that graph in detail, you can see some of the bigger dips that we've come across over the years, things like the GFC and COVID. So I guess the answer to this question is your super goes up and down in line with investment markets. It can impact your balance, but when you step back and take a look at that bigger picture, you can kind of see that market dips happen, but overall that investment trend is positive. So I guess the follow-up question that we get to this one is, should I change my investments when markets go down, or how should I respond? I think it's really worth acknowledging it's not uncommon to feel concerned, especially as you get closer to retirement. You've got a higher balance and it starts to feel more real. But I really would encourage you, before making any changes or feeling worried, just step back and take a bit of a look at it from a bigger picture. Think about things like how long you have to access until you're going to access your super. So those short-term movements matter a bit less if your time frame is long. And then secondly, I think it is worth understanding how comfortable you are with these ups and downs. All investment options are going to move, but some are going to have more volatility than others. So having a think about how that makes you feel is worthwhile. And then having a think about the current investment option that you're in. So maybe you've actively chosen an option, maybe you're in the default lifecycle option, but in both cases, it's been designed with a particular level of risk in mind, with a long-term objective. So just taking a minute to reflect on those can really help you understand whether you're thinking about long-term trends and long-term needs, or if you're reacting to some of those short-term market movements. But I do think it's worth spending a little bit more time on this, Pat. We've had quite a few questions come in, given the state of things that are kind of going on in the world at the moment. And I think that this question is a really kind of good summary of what we've had people asking. Is my super safe in the current economic environment? So Pat, I might hand back to you to give your perspective following on from those kind of graphs I've showed.
Yeah, thanks, Jenny. And look, that is the kind of question that as a coach, maybe those exact words or sentiment really around that same kind of concept is really common at the moment. And I'll probably cover off a lot of the things that you've raised in the last slide, because they are really relevant to the main big answer to this question. And of course, it's natural to be concerned when things are uncertain. So at the moment, we're talking about energy markets, transportation, AI and technology is very volatile. Of course, there's concerns around interest rates. So there's a lot of things to be uncertain about at the moment. And as humans, we've pretty much evolved to avoid uncertainty, and investment markets tend to not respond positively to uncertainty as well. So it's certainly a time where this is on people's minds. The big picture is really the key to all of this here, and understanding time frame, and superannuation is a long-term investment. So when our investment managers design the investments that our members can invest in, they know and expect that there's going to be periods of volatility and negative returns. And then they monitor and they make adjustments along the way, but it's a long-term strategy. So some of these investments, they're designed to work over periods of 10 plus years, or our life cycle investment is literally over an entire working career. So a really long time period. And that's factored in to know that there's going to be ups and downs. So these short-term events, they can feel definitely unsettling, but we're always looking long-term. The investments that we have, they're diversified. So they're not all in one country or one type of asset. They're spread out to help manage that risk. And then we use structured monitoring and processes rather than knee-jerking to whatever happened today or yesterday, which is natural to want to do. But when you're investing long-term, having a plan and diversifying is really the key. At an individual level, someone, starting work in their teens, they're going to be invested in superannuation for over 40 years. Someone closer to retirement, they're going to have different considerations to the teenager. And then, of course, we're all just different to begin with, regardless of our age. So that's why there is a broad range of investments for our members to choose from. And you're talking about understanding what you're invested in and why. Maybe you're not sure. So the investments are there as tools to use, and you can use the right tool for the job. So we've got coaching available, and we can give our members advice to help choose the option that's best for them in terms of their comfort at risk, their long-term goals, and where things are going at the moment. So do reach out for help. And I think flag one other thing, there's an investment we haven't spoken about, which is property, and we get asked about that all the time. So Janine, what can you tell us about property?
100%. That comes up all the time in webinars, in questions to the coach team. I think it's something that's kind of really common, particularly in Australia. So can you use super to buy an investment property? And if you've been watching the markets and thinking, oh, is property more stable, or where should I go? This one might be something that you submitted to us. So I think the other thing to just acknowledge here is sometimes people hear this, it's come from a friend, it's come from a colleague, it's come from a family member. But I think just quickly, in most cases, you can't use super to personally buy an investment property. And if you did hear that from a friend or a colleague, it's perhaps true that they are using a self-managed super fund to do that. But self-managed super funds do come with quite strict rules. They are not suitable for everyone, and they are something that is worth really understanding well if you wanted to go down that path. But in terms of property, super funds often are invested in property. I would say almost always invested in property in lots of different ways on your behalf. So it could be through commercial property, it could be a property trust, a listed property investment, it could be a diversified investment that includes some kind of property exposure. So you can't pick a specific property that you want to buy and do that within your Smart Monday account. But just rest assured that, as Pat said, when we're looking at different things that are happening in investment markets, property is part of your investment mix. That helps with the diversification, and it helps us manage those long-term investments. That is super. So if your friend did say to you, oh, well, I've done this, it is possible that they had an SMSF. It's also possible that they haven't, given you all the information about how that took place, the risks, the rules. So for most people in a typical super fund, direct property ownership isn't available, but you do have exposure to property in your investments. Okay. We want to keep moving, make sure we can get to the live Q&A. So insurance is something in super that we get lots of questions about. So let's have a look at some of the most common ones. Pat, do you want to maybe have a look at this one?
Yeah, absolutely. So we're talking here about how do I know if I have the right amount of insurance? So in Smart Monday, you will get given insurance generally automatically. And in most cases, the insurance that you get given will be based on your age. In some circumstances, it might be because your employer has nominated a certain formula, but most times it's going to be based on your age. And what we know is that most of our members simply keep the level of cover that they've been automatically given. Now, that's a good starting point because we want people to be insured and manage their risk, but we're all different and our insurance needs change over time. Work changes, family and finance changes. It means that there isn't a single right amount of insurance. It really depends on your personal situation and also what you're trying to protect and the level of comfort you want. So we can see on the slide, the main kinds of things that are most often a consideration. And I think everyone on the seminar today will see one or a few of those and go, yeah, that could relate to me. It becomes quite real. And if you think about your life and these factors and think, the terrible question, which is what would happen to the people around me if I was to pass away unexpectedly, or maybe I became unwell and I couldn't work, and it can be pretty uncomfortable. So making sure you have the right amount of cover in place to address your needs can definitely give you a bit of peace of mind. To address this, how do I know if I have the right amount? There's some tools and advice that you can explore if you do want to go into that. The Money Smart website has a really helpful calculator which you can access online. And the coach team, if you reach out to us, we can review your situation and help prepare a personalised insurance recommendation for you as part of our personal advice service, which is included in your membership. So you won't pay any extra to access that level of personal advice. And it can be quite complex figuring out what insurance you do need. Once you know the level of cover that you want to have, you can apply to the insurer for more insurance in most cases, and you can also decrease the cover if you have more than you need. And that's just a matter of completing and submitting a form. Now, when we highlight to that people, we always want to keep in mind that if you do reduce or cancel cover, the insurer is not obliged to give that back to you in the future. So just a little sort of brainworm there to keep in mind. But you've got all the options when it comes to the insurance. And the first step is always to understand how much should I have, and then figure out your steps from there. So the next questions that we commonly get asked in insurance is talking about income protection insurance. And can I claim on this insurance if I lose my job or I'm retrenched? And in these situations, the unfortunate answer, and it can be disappointing, but the answer is no. And it's important to understand that income protection insurance, it can't be confused with an unemployment benefit or a protection against unemployment. So income protection insurance, it's an insurance policy that protects an income that you have, but you get prevented from earning because of an illness or injury. A really common thing to keep in mind is maybe some kind of manual labor or a builder that gets injured and they can't do their work. So these insurances, they have a set benefit period, which is how long you get paid for if you cannot work. So 2 years or 5 years are really common periods. And then there's what's called a waiting period, which is a period of time that you have to wait before you can actually claim on that insurance. And that's because most people, when they are in employment and then they have this sort of injunction that stops them from doing it, they often have sick leave or they'll have some savings that can sustain them for a short period of time. So if your role is made redundant, so you're not employed anymore, it's worth reviewing the cover. You may need to opt in to continue income protection insurance in the fund if you do leave the employer. And you may also then end up in a situation, depending on your work circumstances, where you have cover that may not be suitable for you anymore. So do reach out if you end up in that situation so that we can talk you through what your options are and how to go next. Now, also, when we're talking about leaving work, Janine, what about retirement? Because that's a really, really, really big topic. That's what superannuation is all about in the end.
Absolutely. So let's keep moving. The first one that we get asked reasonably often is, do I have to wait until I'm 67 to retire? And the answer is no, you don't. There is no official retirement age in Australia. So the rules in super really do relate to when you can access your money. But you can retire whenever you want if you've got the money in other assets and things to support you. So you start being able to access it from 60. 65 is when it becomes much more fluid and kind of flexible. And then 67 is the government age pension eligibility. And there's some income and assets tests that apply to that. So I think the other thing is we spend a lot of time talking about accumulating money in your super, but when the time comes, how do you actually get any income from that money, from that super balance? So let's just say you are over 60 that we just mentioned. You've got two options once you hit that age. If you're still working, you can begin to access some of your super tax-free through what's called a transition to retirement account. If you retire, you can start using what's called an account-based pension. So there's different reasons you would want to access either of those. It depends on your personal circumstances, but basically you start being able to draw down on your super and being able to access some of that balance that you've spent so many years building up. So Pat, maybe you can go a little bit deeper on this one.
Yeah, absolutely. So these are key things about how you start planning, or when you get to that retirement stage, start taking action about how to use your super to actually fund your lifestyle. So the two options that we're talking about here, the transition to retirement pension or the account-based pension, have a few little differences. So the transition to retirement account is for when you're still working. So from age 60 and then up to age 65. So anywhere in that window, if you're still working, you can use that account to start to access your super. It will mean that you have two accounts because you would have a super account to receive your employer payments and then the drawdown account, the transition to retirement account. Now, for an account-based pension, you've either stopped working or you're over 65, and that sort of explains itself. So in terms of the two accounts, tax is a key feature. For both the transition to retirement account and the account-based pension, the payments that come to your bank from those are tax-free. However, the tax difference is the transition to retirement account. Any income that generates from investment returns is taxed at 15%, whereas the account-based pension, there's no tax on those returns either. Other key difference between those two types of accounts is how much you can withdraw. Now, both of those accounts will have a minimum amount that you have to withdraw. However, a transition to retirement account also has an upper limit, which is 10% of the account balance that you can take out. So if you can access a transition to retirement account, it will allow you to access some of your super, but it won't be the full amount. Whereas when you move to the account-based pension, you can withdraw any amount that you like. There'll be a minimum, but there's no cap. So if you're at the stage where you're looking at these options, definitely useful to get advice because the features of the accounts are different and how you strategize to plan to fund your retirement or your lifestyle can be quite different. There's a few factors to keep in mind. So do reach out to the coach team if we can help you with that or you want to drill in deeper. Now, how much do we need to retire, Janine? That's the big question.
Yep, 100%. It's probably one of the most common questions. And I'm sorry to tell you that there's no specific answer. And that's because we're all different, our lifestyle, things like home ownership, and, what we want to do with retirement, how we want to spend that time and what that might cost. So ASFA do publish some numbers. They are really helpful. You can see them on the screen. But Pat, I'm actually going to throw it back to you. So someone rings the coach team and says, how much do I need? What do we do? How do we help them?
Look, firstly, I think how do we help them? We have a really good chat. And the key thing about that is understanding that, ASFA's got this box on the screen and that's based on a balance or a lifestyle that they've determined. But for every one of our members, that's not going to be the exact fit. So things that are going to impact people significantly in their planning is their housing situation, renting or ownership, if they're single or in their relationship, whether they're going to be eligible for the government age pension or not, how old that person is, how long have they got till they retire or how long are they retired already, and then what kind of lifestyle they want to lead, which is going to be different for everybody. So, how long is a piece of string is this answer, but it's important to understand the factors. So those ASFA numbers, they're a really good place to start, but flagging that they assume that you retire at age 67, and that's quite often not the goal when we're talking with our members who want to retire well before reaching that government age pension age and want to make their own decisions on their own timeline. So let's use these numbers. They're great, but they're not, anyone's personal target. So many aspects to talk about. Now, when we're planning about this, there's a couple of ways to get started, to start thinking about what do I need. On the smartMonday website, we've got a retirement calculator that you can play with, and you can put in your numbers there and you can test them. So you can see where you stand today. You can play out an unlimited number of scenarios. It's a really informative tool if you want to do a bit of self-exploration around if I have this, what happens, or if I aim for this, how do I get there? Really good. Or you can contact us in the coach team and we can help you make some decisions around what you're aiming for. And then we can talk you through how the different tools in your super work. So your contributions, your insurance, your investments, and how to use those to get towards that goal that we've kind of helped to determine you with. So if you're heading towards retirement, you're in your 50s, now's the time to start thinking about what are your goals, what are your actions, and what do I need to do next?
Awesome. So that brings us to the end of the first section. We do really want to make sure that you've got actions, and then we're going to jump into the live Q&A. So do just always make sure you're on top of your super, log in, check your account, just make sure your contact details and things like that are up to date. Just stay in touch with it. It's your money. It's a really important part of your overall financial picture. I always say write down your questions. You know, if something springs to mind and you don't have a moment to get in touch with us at that time, you can reach out to us. You don't have to wait for a session like this. So do seek help, advice and support when you need it. Now we're going to jump into some of those live Q&As as well. So I might just check in with T and see if there's anything sitting there that we haven't been able to answer. And I do have some other ones that were pre-submitted as well.
Hi, Ron. Thanks, Janine. We did have one sort of related to property. Is it possible to use super to pay off an existing mortgage?
There's a lot of it depends on that one, isn't there? So
Right.
people do sometimes reach retirement with debt, and sometimes they do want to look at how that fits into their retirement planning and that type of thing. But in terms of, you know, someone like myself who might have a mortgage and using my super now before I reach that preservation age, it's probably not so likely. Pat, do you want to add anything to that one?
Oh, look, yeah, I'd maybe be more certain than saying it's not so likely than just to say no. So if you're a mortgage holder and you haven't met the conditions of release of super, which are generally being 60 and then maybe some other work-related things, if I refer to myself, so, you know, I'm in my 40s and I'm working full-time, could I draw out my super to take that cash and pay off my mortgage to the bank? No, I can't do that. It's just simply not doable. Paying off a mortgage, yeah, it may be to do with a self-managed super fund if the property is owned in the self-managed super fund, but other than that, no. The only caveat I would put there is there are early access allowances that the ATO manages under what they call compassionate grounds. And if someone's in a situation where they may have their house foreclosed upon or, you know, forced sale of their house because they can't service the repayments on that, the ATO may consider giving some early access under those grounds. So that's maybe the one caveat I have to that.
Thanks, Pat. Anything else there, T?
We did have one around withdrawing for personal costs, which I think you've covered. So it looks like we're good for now.
Okay, so we did have a few other ones come in advance of the session. So we might just cover up a couple of those just to make sure that we're answering as many as we possibly can. So Pat, I'm going to throw a couple of them at you if you don't mind.
Yeah, no, please go ahead.
Can you make extra contributions to your super above the 30,000 limit? And will you pay extra tax on that?
Okay, so look, there's a lot of if this then that. So I think the main answer to that is yes. So a couple of high levels on that. So there's a $30,000 cap on concessional contributions per year. Now, if you haven't used that full 30,000 cap in previous years, up to 5 previous years, you may be able to utilize the portions of that cap that you didn't use. If your balance was under 500,000 at the start of the financial year, you could log into the ATO and have a look there and it'll tell you if we've got any cap space left. So that might allow someone to make those extra contributions and not, you know, pay any extra tax. Other than that, yes, you can make non-concessional contributions above that cap. That's not going to receive a concessional tax rate, but there is a limit of $120,000 on that per financial year, and then you may be able to bring forward future years as well. So that's some clarification around the rules, but it's not a definitive yes or no. So if you're unsure, do a bit of reading on the site or reach out to the coach team and we'll talk to you personally and guide you through what you could do.
Okay, the next one is someone who's looking at moving from full-time employment to casual employment ahead of retirement. So can they keep topping up their super in that circumstance?
Yeah, absolutely. So if this was a hypothetical and you've stopped working full time, you're not retired, but you're working casually, well, firstly, your employer is going to be obliged to pay super to you. So you're going to be getting super there. And then all the same rules would apply to you as to someone else, like the previous question, understanding their cap of contributions they could make in the year, yeah, you can definitely keep topping up into your super if you want to. That's a good way to get that balance boosted before potentially maybe taking it to a pension account where it's tax-free and funds your retirement, for example.
Okay, I've got another one about retirement, Pat. So once I notify my employer that I'm retiring, what do I have to tell the super fund? How does that work?
Okay, yeah, good question. Okay, so it's important to think of the super fund as being potentially like a bank account. You don't need to tell the bank if you want to go out to have dinner or you stop working. The super fund is yours, so you wouldn't be obliged to do anything at all. So I think that's the answer, right? But if you have retired, if you know what you want to do, reach out to the fund, take action. If you're unsure what you want to do, we'd really encourage you to talk to us because we can help lay out all your options for you, and that might help you take your next steps. But if you don't want to do anything, well, you don't have to do anything.
Awesome. Okay, downsizer contributions. This is one that comes up from time to time. So there are some rules around this, but if you are downsizing your house, is it true that you can deposit some of that money into your super? And there's two parts to this, Pat. Is there an age limit, and how would you go about it?
Okay, so downsizer contribution, which you've mentioned there, is for people selling their primary residence, and they might be downsizing or they might just be selling it and moving into a house down the street. But let's say that occurs. If you're over 55, you can, as an individual, so let's say you're in a partnership, maybe each individual, this cap would apply to them, but over 55, selling that primary residence, you could use proceeds from that to top up your super, and there's a cap of $300,000 for each individual to do that. And it is a common thing that we see people as part of their retirement planning, downsizing or moving, and then using that opportunity to put a large chunk of money into their super, certainly beyond what they could usually contribute, and then using that planning towards how they fund their lifestyle when they are retired. So yes, it can be done. There's rules. And there's a few little rules around how quickly you need to do that and what you need to do. So again, if that sounds like something that's interesting to you, reach out to the coach team and we'll take you through the ins and outs of it as well. And then you can make a really well-formed plan.
Awesome. Okay, in the interest of time, we are going to wrap up. If you did submit a question that hasn't been answered today, please do get in touch with us. We will do our best to go through those. We might reach out to you as well. But yeah, if you need anything from us, we are available. You can jump on the live chat on the website. You can give us a call at any time. Please don't wait for the next webinar to ask your questions. And we just wanted to say thank you again for all the people that have spent their time with us today. Hope you've got some actions to take away and some things to do, even if it's as simple as logging into your account and just checking in on your super. Thanks again for being here. Thank you, T. Thank you, Pat, and we'll see you next time.